Welcome to Mongo Spaces. This Wednesday evening, we want to unpack the finance bill, which was released over the weekend. So we have a couple of days left. I think the deadline for submission of comments is 28th of this month. So we have 13 days to analyze and to send in all our comments. So to unpack that, we have three experts. Right now we have Karambo only, but we'll get started with her and then the rest will join along the way. So Karambo, maybe you can start by introducing yourself a little bit and then we can get started on that and what you do day to day.
My name is Karambo Muthaura. I am a health taxes expert. I have been in the tax policy and administration space for the last 18 and a half years. I'm glad to be here.
Ernest has joined us. Ernest, maybe you can say hi also.
Good evening and thanks for inviting me. My name is Ernest Moreau. I'm a partner at Ernest & Martin Associates. We do audit and tax services as consultants.
Ruth will join us in a few, but we'll get started. Maybe we can start with a bird's eye view of the Finance Bill 2024. Karambi, you can give us a bit of your quick takeaways from the Finance Bill 2024 so far.
From the whole finance bill, I see a lot of just revenue raising, and in some aspects, I cannot get very clearly what the policy of the government is. For example, when the reversal of changes that had been done in the previous year, and I can see that this has not been a very long period for us to scrutinize and see whether something has been effective or not. And also, I see a bit of tax reduction in areas where we are grappling with as a country. For example, I see a remission being offered on being made from locally grown agricultural products. And it leaves me questioning. I see the DP is fighting alcoholism, and then we are making these changes that don't seem to be heading in the same direction. And some of the proposals in the act are really, some I'm for, and others I am left with a small question mark that I would want to understand further also.
And Honest, maybe you can give us also your quick bird's eye view of the Finance Bill 2024 before we dig into the details. So,
like with every other finance bill, it's a mixed bag of things, good, bad, ugly stuff. Some of the good things are good and some of the bad things, some are really terrible. But I hope during public participation, Parliament will be receptive in listening to views from the public in modifying items they have in the bill so that we do not have cases going to court like we've had with the Finance Act 2023 and the Housing Act 2024. So my prayer is during public participation this time, it should not be an academic exercise. It will be a real receptive and collaborative exercise between the public and National Assembly. Thank you.
you have 13 days to analyze and send in your comments. So very tight schedules. So let's start with maybe again the quick overview of what's the good, the bad, and the ugly from your perspective, Ernest.
So some of the good is the improvements in terms of the pension, making pension and provident savings that are received tax exempt from at 60. So I think that is pretty good. You do not have to wait until you're 65 to access your pensions tax-free, and you can also access your pensions tax-free after 20 years. So I think that's a very good proposal for encouraging people to leave their money in schemes. They've also increased the tax allowable pension contributions to 30,000. So I think that will also help and encourage individuals and companies to save in pension schemes. I think that for me is the good. The bad, of course, you start with the bread, the motor vehicle tax or the road usage tax, and it's still quite suspect. Bread, I don't think was necessary. A lot of exemptions have been dropped, some within the financial services sector. Of course, the increase in the excise duties in financial services, money transfer, I think that is really bad. What would I call the ugly? Some of the proposals you'll find in the eco-tax, introducing an eco-tax on diaper. I think that will make diapers pretty expensive. Introducing excise duty on cooking oil, I think that will also be terrible. There's several other bad and I believe proposals in this bill that need to be really looked at and cleaned up. I hope Parliament will be receptive to that.
Thank you, Ernest, for the broad overview. Karambu, maybe your good, bad, and ugly takeaways before we go into the nitty-gritty details now.
I think my first really ugly is a motor vehicle tax. I don't think that is encouraging to anyone, and it makes life extremely expensive for everyone. Also, moving excise duty from motorcycles and leaving it only for the electronic motorcycles, then of course that will deter people from onboarding the use of electronic motorcycles, which means in essence that we are encouraging continued pollution from the use of petrol motored motorcycles. The other ugly thing for me is seeing that they're making every effort to stop even the cabinet secretary from making any adjustments, either upwards or downwards on excise. And then we have, of course, the increasing of excise duty rates on financial services. And one of the things that bothers me there is because when we talk about mobile money transactions, then what we had done is that we had managed to get through to the unbanked. And because this is becoming expensive, then I think a lot of people will avoid making transactions because making the transactions is already expensive. And so when you increase it again now to 20%, and then you are adding more fees that are going to be excise, then the whole finance industry is just going to be expensive for the mwananchi. Just dealing with your own money is going to be extremely expensive for you.
Now, starting the nitty-gritty details now. And Ernest, maybe you can take us a little bit through the income tax changes that have happened in the Finance Bill 2024 and how they impact the listener.
Many amendments in the Income Tax Act. So some are new proposals, and some is to replace existing taxes. So there's what they call in the significant economic presence tax, which is a tax that has been introduced to replace the digital services tax. From a mechanism and operation, the digital services tax was being levied at 1.5% on the gross turnover. The significant economic presence tax just has a middle step. It says that they will deem a taxable profit of 20% of your turnover and then tax that 20% deemed taxable profit at 30%. So in effect, the tax rate has increased from 1.5% to 6% of the gross turnover. In terms of payment dates, remains the same on the 20th of the next month.
I wanted to double click on something there. So the deemed tax, maybe you can break it down a bit for our listeners. What is that exactly?
So if your income was 100 shillings, then they will deem that you had a profit of 20%. So your profit is 20 shillings. Then you'll pay a tax at 30% of that 20 shillings. So effectively, it will be 6 shillings as the tax payable. So that 6 shilling as a percentage of the gross is 6% of the gross income that you've earned or the revenue that you've earned from that service. Then they've introduced a new tax called the minimum top-up tax. This has a complicated formula, but it is being targeted at companies that exist in Kenya that are subsidiaries of very large companies globally, in terms of companies that have a global turnover of 750 million euros. That is more than 100 billion shillings in gross turnover. Effectively, these are very significant companies that will be affected by the minimum top-up tax. I would not like to go through the detail of how it works, but basically targets subsidiaries of very large companies.
And some of the companies that you think may be impacted by this minimum top-up tax.
So if you're a subsidiary in Kenya and your head office in Europe or in the United States, for example, in the IT sector, in the pharmaceutical sector, that's where you'd find large companies. Motor vehicles, if you're a motor vehicle distributor, say a company like Toyota, which has a presence in Kenya. So such large organizations, yes, their subsidiaries in Kenya would be subject to minimum top-up tax. And if the effective tax rate based on their computed profit and loss is less than 15% of the profit, then they would have to pay the top-up tax. So the next thing is the income tax proposals includes what we call, for transfer pricing, advanced pricing agreements. So advanced pricing agreements is where you have in related party transactions with companies outside Kenya, and you want to have a stable working environment. You go and agree based on the OECD transfer pricing guideline on how to price your products, your services with your related parties outside Kenya. And once you have come up with those prices, you go and you agree with KRA. If KRA approves those prices, then you can be able to apply those prices for 5 years. That means if you apply the prices consistently, then you do not get exposed to a transfer pricing audit like KRA, which is good in terms of stability of prices. all KRA will just come is confirm, one, those prices applied as agreed, and two, you did not misrepresent the pricing mechanisms or the information that you had given them. So if there was no misrepresentation and the prices were done as agreed, then KRA for 5 years will not subject you to a transfer pricing audit, which gives you predictability. When it comes to transfer pricing, lack of predictability can be a challenge for businesses. But once you have an agreement that is signed off with KRA, then there will be stability in your prices for 5 years. They've now introduced withholding tax to the digital marketplace. This withholding tax is at the same rate as normal withholding taxes, 5% for residents and 20% for non-residents. So this now gives us uniformity in the withholding tax rates. Previously, the rate that were used for digital market services were different. But now that we have the withholding tax uniform with all other services, professional services, royalties at 5% and 20%, where the definitions are not clear, there will not be a risk for any disputes with KRA, because it doesn't matter how you define your product, the rates are the same. So those supplying goods to public entities, new withholding taxes have been introduced or proposed for any resident person selling to a county government, the national government, parastatals, or any other state department or agency or corporation. The withholding tax rate for residents would be 3%, and the withholding tax rate for non-residents would be 5%. I don't know how this will work for the counties, because counties generally do not remit withholding taxes historically, but other MDAs, ministries and departments do withhold and remits. But county governments are notorious for non-remission. So which will not be good, because if they deduct the amount from you, the supplier, and they fail to remit, that means you're losing the advance tax that you would be able to apply when you're doing your year-end computation. So my expectation is the government then should surveillance of counties, probably deduct any amounts of tax that should have been remitted from distribution of funds from the national government to the county government. The definition of royalties has been expanded. So royalties has now been expanded to include software. So software was not previously included in the definition of royalties, but from a lot of cases that have happened in the past, the software was deemed a royalty, but now it is expressly included in the bill. This includes also software that is sold through physical devices, what they're calling off-the-shelf softwares. We expect now it is clear when applying withholding taxes that any person who buys any software online or physically from a shop will be required to pay withholding taxes. Some potential risk, because when you buy software in physical devices, in a CD, in a flash disk, then this will create additional costs to the vendor and to the users. So it will make software a bit expensive going forward. And the affordable housing scheme, so the reliefs that were provided for under the Income Tax Act have been proposed to be removed in terms of affordable housing relief for the levy and affordable housing contribution relief of 15%. However, on the other hand, they have made any contributions in terms of affordable house levy will be deductible from your income when computing your income tax. This, of course, will be better, because any amount that you pay, the 1.5% levy that the employee pays will be reduced from his taxable income, and basically gives you a relief of 30% from the tax that you pay to KRA. So I think that is a good introduction that will provide additional income to Kenyans who have had their income reduced because of the affordable housing levy that was reintroduced this year by the Affordable Housing Act.
On the affordable housing, I was curious, how come they're making changes this soon after the bill was passed, like a couple of months ago?
The first reason is just to increase the disposable income for individuals, making this amount tax allowable. That means the effective amount that you pay is 70% of the 1.5% that is being deducted. So that 30% becomes additional income to the levy payer. And also, on the other hand, for any business that is contributing this affordable housing levy will be a tax allowable expenditure. So it will also help in reducing the tax that you pay.
And then backing up a little on the minimum top-up tax, do you think multinationals would reconsider Kenya as a destination to invest, given that the tax is now being imposed on them?
The minimum top-up tax is part of the global anti-base erosion strategies that have been adopted by the OECD. So I think the large multinationals that are being targeted by this are already applying it in other jurisdictions. So I do not see it as a disincentive for them. I think they will just, as a matter of course, comply with it, because I don't see many large corporations just leaving because of this tax. And of course, given that many of them are already having transfer pricing policies, and these transfer pricing policies are geared towards ensuring that your businesses are profitable, this will be built into the transfer pricing rules to ensure that the taxes that they pay do not fall below 15%.
Thank you, Ernest, for that very engaging introduction to the income tax changes that are supposed to be happening. We'll come back to you with a couple more questions as they roll in. And to switch a little to excise tax, and first of all, before you go there, we'll start with the motor vehicle tax. Can you break down a bit what the proposition by government is as regards to the motor vehicle tax?
A moment, kindly.
All right. In the meantime, if you have any questions, just go below our pinned tweets and just type in your questions. I will definitely be able to look at them as regards the finance bill. Just below our pinned tweet, you can also see a link to the PDF of the finance bill 2024 if you want to dig into it a little bit more. We hope next week to have a discussion around how you can submit your comment. We have a really high-level panel that is joining us next week to discuss submitting some of the comments that you have as regards the finance bill and why it's important to participate in the process. So now we can come back to Karambu, the motor vehicle tax, and why you don't like it.
Why I don't like it, all right? Oh, it's quite clear that I don't like it. So the bill is proposing a motor vehicle tax, which will be payable on every motor vehicle at the time of an insurance cover. It's applicable at a rate of 2.5% on the value of the motor vehicle. It's based on the make, model, engine capacity, year of manufacture, the same thing that is done when you are estimating the value of the vehicle during purchase. And then there's a minimum amount of 5,000 and a maximum amount of 10,000. And whether your vehicle is electronic or not, this applies to your vehicle. So it's up to the insurer to collect this amount from you while issuing the insurance and then remit it to the commissioner. And if he doesn't, he has a penalty of 50% of the collected tax. The reason why I do not this is because I feel first it results to a double taxation, like for commercial vehicles, which are already subject to advanced tax. And of course, it's not a deductible amount. The advanced tax is not a deductible amount. And then it's going to also discourage motor vehicle owners from taking comprehensive insurance, because if the rates are high and then you have this additional tax, then the process of getting insurance will be a very expensive affair, which already it is. And so it will increase the cost of doing business, even for insurance companies. They have to reconfigure their systems, TC, and also just for any business owner or even for an individual, this comes as an extra cost, which I feel is too heavy a cost to impose on anyone right now. So that's the reason why I do not like the motor vehicle tax. You can imagine every year paying your, let's say, 10,000 shillings. 10,000 shillings. At some point, just having a motor vehicle would be such an expensive affair.
What do you think is your intention in terms of, is it just revenue raising, or do we really have to link it to something at the end of the day?
No, I think it's just revenue. It's just revenue collection. A lot of the proposals in the act to me seem to be just revenue collection, and this is one of them. I know it had been proposed MTRS, but it's not like we pick everything that is proposed through that. But I know highly that this is just a revenue collection item. Ernest?
Yes, I agree.
It's just intended to increase the revenue collected from taxpayers and any person who owns a motor vehicle, because people probably have not been using the motor vehicles much, so the fuel consumption was pretty affected by the increase in VAT. In other words, if you're an intermittent user, you just pay one block amount at the beginning of the year, and that increases how much they collect. If you're going to be using your car once a month, once a week, yes, you'll still have to pay this tax as compared to the person who uses their vehicle every day. So this is a revenue raising measure.
I saw an estimate of around 5% of the cost of comprehensive insurance currently. So adding 2.5%, now that will take it to 7.5% of the value of the car per year. So that's quite substantial. Has anyone of you looked around in terms of other countries, in terms of how they've implemented this tax and what percentages are proposed there? Because sometimes the government makes the proposal to be 2.5%, Kenyans make a bit of noise, and then maybe they end up at around 1.51%. Is that probable here?
This tax almost is as the old road license tax that we used to have in the 90s that was replaced by the fuel levy. So in the olden days, a similar tax operated. You used to pay the amount based on the engine capacity rating. So I think it's more or less a reintroduction of an old tax regime. So it would be probably nice to look at how the old tax was worded in the law. But in terms of mechanics, it's more or less the same. The only difference is that previously KRA would collect this themselves. Prior to that, the Department of Motor Vehicle used to collect it, but now they're going to use the insurance company to collect this money. So I think other than the mechanic of collection, the other parts are more or less the same because the commissioners have been given powers to come up with guidelines on how to determine the valuation of motor vehicle. Probably, I think he may adopt a scheme or policy or procedure similar to what he uses for purposes of custom valuation, because one of the method is supposed to use is the model, the engine capacity, the year of manufacture. So when you see that, it only reminds me of the customs valuation methods. So I think valuation will not be based on market value because the word market value has not been applied anywhere in this proposal. So I can only see him using the customs methodology.
And what is the difference between customs and the normal market value? Substantial usually?
Of course, it does generate dispute because sometimes you will find the market value may very much vary from the actual value that the carrier has used. But here, since the market value is not anywhere applied, we just have to go with what carrier will come up with, what they come up with the regulations.
Tough one. Karambo, do you have something to add if I got to do?
Yeah, I think since this is something that had been replaced with the fuel levy and we are not doing away with the fuel levy, then obviously it seems that like we are really overtaxing the mwananchi. But I agree with Ernest that most likely they did this to catch those of us who have not been using our vehicles as regularly because of the increase in the cost of fuel. But if they were to introduce something like this, then I don't see the place of the fuel levy.
From a discussion yesterday, I think that the chair of the finance committee seems to say that the proceeds from the road maintenance levy were not enough, and that's why they need a motor vehicle tax to compensate for it. I think, as Anna said, it could be that there's been a drop in terms of demand for fuel, given the height that was introduced last year. There's just the increase in VAT last year. I think that has maybe led to a lower demand for fuel, and that has maybe made the government rethink in terms of how to collect money for this levy. So that's the motivation here. In the meantime, now I want to introduce Ruth, our third speaker. She had quite a bit of a tough time joining, but Ruth, you could say hi and maybe introduce yourself a little bit.
Good evening, everyone. My name is Ruth Mwiti. I am a tax consultant. I've been in the industry for about 10 years now, and I'm happy to be here and thank you for inviting me, and I hope we will be able to see some of these changes effected and some of them drop. Thank you.
Yeah, the aim will definitely to collect some of the comments that we receive on the forward them to Parliament by the 28th of this month. Ruth, any perspective on some of the things that you discussed, especially the motor vehicle tax, can you give us a bit of your perspective?
All right. The motor vehicle tax, for me, is a bit interesting, and maybe my comments to add into what my colleague said is that I see it more like a proposal that will definitely come through, but because every Kenyan is complaining, probably we will see a deduction. And why I say that, you remember last year when the first finance bill came in, there was a 3% housing fee. And then after discussion, the chairperson of the finance committee said that you asked for a reduction and you got it. So if you had a look at Secret Finance Bill that was shared earlier, it was at 1%. The motor vehicle tax was at 1%. And then now it was increased to 2.5%. So I see the proposal probably will go through, but maybe at a lower rate.
Maybe you can give us a bit of flavor on some of the introduction from the finance bill as regards VAT.
I will start by probably mentioning the negative one, and this one is in relation to the proposed introduction of VAT on certain financial services. And looking at historically, financial services were not subject to VAT and have not been subject to VAT. And as my colleague Karambo said, the idea is to make sure that you bring everyone to the banking bracket. So when you introduce these taxes like VAT, then a transaction that probably is charged 100 shillings, that means you will pay 16% VAT and you also pay excise duty. And the question is, if I am going to pay close to 50 shillings from 100 shillings, then why do I need to put my money in the bank? Some of it is not fair. And also, given that now all these services are vatable and some are non-vatable, how do the banks track the exempt services and vatable services? Because some of them tend to complement each other. So this ideally, in my view, will increase dispute. Why? Because some financial services are exempt, some are vatable, and the second impact is that it will make banking services very costly and people will shy away. You remember sometime this year when people started saying that the M-Pesa transactions are being tracked, there was a decline in the revenues reported by the telecommunication providers or the M-Pesa services providers. So I feel like, yes, your intention is to raise revenue by increasing or introducing VAT, but when people shy away, like the fuel issue, then you lose out of the revenue and it is not fair. And just to add on the fact that these changes are coming year in, year out, it is so difficult to track these changes, and definitely that increases disputes. But I hope that this provision will be reviewed, and after review, I hope it will be dropped because it's a very punitive provision in my view. The other proposal that I want to talk about is the obvious one, the one for bread. Bread has been derogated for quite a while now. So introduction of VAT on bread, what are we telling Kenyans? That even the thing that they need most, you will have to pay VAT, and it's unfair. My view generally is the fact that changing law year in, year out, even without having to look at the impact of previous proposals, does not help government. Government needs to look at what is working, analyze it, and then implement, or rather take some time before introducing other laws. The other one I would like to talk about is the proposal to introduce VAT on betting, gaming, and lottery services. And this will be at the rate of 16%. So I think this issue of betting companies, I know Karambu will talk about the excise duty that is on these services. The question is, for those people who bet, how much will be your bet? If you're being deducted excise duty, betting and gaming taxes, and now again VAT, I hope they will be considered, but there is that proposal to introduce VAT on betting and gaming services. The other one, which is a positive one, is the proposal to introduce or to increase VAT threshold for registration of VAT. Currently, for you to register for VAT, you are required to be making sales of 5 million and above per year. So the idea through the finance bill is to increase this threshold to 8 million, which is a very positive move, given that some of these people who are registered for VAT are just probably even not making so much money, but they have to comply with VAT regulations on the basis that they are within the 5 million threshold. So that is a positive one. Then I will talk about the VAT exemption that had on transfer of business as a going concern. So if you're transferring business from one person to another, that had VAT, or that currently VAT is applicable on such transfer of business. So there is a proposal to introduce a VAT exemption on those transfers. The other one is on insurance and reinsurance services. Currently, insurance services or insurance services are exempt from VAT. But what the finance bill seeks to do is to restrict only the insurance and reinsurance premium. So any other services that are associated with insurance beyond the premium will be subject to VAT. So if this proposal comes through, then we will have a very difficult time, because any other thing that you're charged in addition to your premium then will attract VAT. And if you look at the intention of insuring, then it should be exempt so that everyone can be able to make sure that they insure their property, they insure themselves in terms of health. So when you now tax everything, every other expense that is related to that service, then it becomes very, very costly. There are some other exemptions that finance bill proposes to remove. What I need to say is that there is a difference between what exemption and zero rating. Exemption is at 0, yes, but the services or the people who are VAT exempt are not able to claim input VAT on their supplies. Whereas for a zero rated product, you can be able to claim VAT, input VAT incurred on that product or that service, and therefore making it cheaper because you have a credit of the input VAT. So what are some of these proposals that the government or the finance bill is intending to remove the VAT exemption? So currently, taxable goods for direct and exclusive use in construction of tourism facilities, recreation parks, probably those construction or those goods that are used in the construction of those facilities are exempt. So there is a proposal to introduce VAT on that. Then specifically or specially designed locally assembled motor vehicles for transport of tourists. So you see those trucks that carry tourists, and if they are assembled locally, they are exempt from VAT. So there is a proposal to remove that VAT exemption, meaning that those motor vehicles, if this bill passes as it is, then those motor vehicles will be subject to VAT. And the question, of course, is if you are looking at an intention to promote tourism, and then you introduce VAT on the construction of the tourism facilities on the motor vehicles, then what are you saying? Are you looking to grow the tourism sector, or are you discouraging investment in that sector? It is unfortunate, but that's what it is. I hope some of these proposals will not pass through. Then the other one I can mention, current electric bicycles, solar and lithium batteries, electric buses are zero rated. There is a proposal to introduce VAT on those supplies. There are other numerous proposals, like for instance, the agricultural sector, so provisional inputs and raw materials which are used to manufacture agricultural pet products. Those ones have been zero rated, but now they will be exempt. So if this goes through, then the expectation is that because exemption, you cannot claim input VAT, then the cost of these items will go high. Definitely, the ripple effect is that the end user or the farmer will have to coffin additional money, and directly that goes into the price of the product in the market. Those ones are the ones that I can mention.
Yes, thank you for that. So the next thing I wanted us to discuss is on the changes, specifically regarding pension and accessing retirement benefits. So can you give us a little bit of a breakdown on what happened there?
So they've deleted the provision that says retirement benefits collected after the age 65 are tax exempt, and replaced it with payment of pension funds from a fund after the attainment of the retirement age determined by the rules of the fund. So generally, most funds have the retirement age anywhere between 55 and 60 years. So the pension benefits payment will be exempt from tax, so long as you collect it after the retirement age. If you retire due to ill health, then you can also collect your pensions tax-free. If you withdraw after 20 years from the date you registered into that fund, also you'll collect that money tax-free. So those are the provisions that have been incorporated into the Income Tax Act.
And one more thing, there's a change in family trusts, all right? Could you expound on that a little bit?
Yes. So recently, the family trusts were incorporated into the Trustees for Perpetual Succession Act, and consequential amendments were put into the Income Tax Act. Some of the provisions in the Income Tax Act include the income of the registered family trusts are exempt from income tax, and any capital gains that are incurred at the point of transferring property into the trust are also exempt. So they're proposing to remove those two exemptions in this bill.
And what does that mean practically now?
So if you have a trust, remember a trust is a vehicle that is used to manage your estate, to manage succession, and also to protect wealth in a multi-generational way. So the income that is derived into the trust ideally should be tax free, and then the beneficiaries of the trust will be taxed at the point of which they draw money out of that trust in accordance with the trust deed. So now every income now that goes into the trust will be subject to tax, just like any other entity, any other corporate entity, and then the beneficiary will get the income tax free. When you transfer in property, say you have a piece of land somewhere, you have a building somewhere, and you want to move that trust building into the trust, then any capital gains that's crystallized at that point of transfer will then be subject to capital gains tax at 15%. Presently, such transfer does not trigger capital gains tax.
And what would that mean then going forward? Would people avoid using trusts, or maybe transfers would be minimal?
So definitely moving properties into a trust then will create a serious disincentive. And now people then would now fall back to the exemptions under the 8th schedule. Instead of using a trust, if you have not created one, then you'll be more likely to use what is called a family company. So a family company, the transfer of any property into a family company, that is a company that is owned by an individual and his children, and or with a spouse, such a transfer it will be exempt from capital gains tax. So there will be then a disincentive to use trusts, and people will start using companies instead, because sometimes the capital gain can create a very big disincentive to move the property into a trust. Unless then you're moving that property into the trust for cash, then the cash will be used to develop the property. But a physical property, yes, will be a disincentive to move it to a trust.
Thank you, Annette, on that. Karambu, now over to you in terms of the changes in excess duty. The significant one in impacting M-Pesa transfers.
First, on the M-Pesa, what has happened is previously excise duty had gone down from 20% to 15%. And I had looked at that as the government trying to make sure that Kenyans are still bankable and that they can basically the movement of money within the economy. When this was reversed within such a short period of time, back to the 20%, and then other fees added to the fees that are now excisable, then what I see is the government trying to reduce the use of M-Pesa services, because definitely a 5% on your fees for anything you do is a large amount of money. I think if you use M-Pesa frequently and you check the amount of fees that you pay, it's quite high already. So when you add in the excise tax on that, even if we are trying to raise more revenue, when you add the excise tax on that, then it becomes very expensive for the mwananchi. And especially at a period like now when there's a lot of complaints from everyone about how they're not doing well economically. So increasing this fee for me is a no. It's something I don't agree with. It's something I would recommend to be rejected. And then just not that, I think they've done that on fees for transfer, the fees on telephone and data, money transfer everywhere from all providers. So then that becomes a big problem.
All right. Any other excess duty impacting transactions before we go to rules for some changes in the tax proposal?
We have a few changes on rates. Yeah, but before we get to the rates, there are some things I need to clarify. Some changes that have come through. I think some are good for the business person. One is like when we've had committee on classification, because if you looked at the first schedule to the Excise Duty Act, you'd find that a lot of naming was not the same as what you find in the East African Custom Management Act, and therefore just knowing how to classify the goods, whether your goods are excisable or what exact tax rates apply to a certain product, sometimes could be very tedious for the business on. You don't necessarily need to take your samples to KRA to have an idea of what taxes you should pay. I believe that, and therefore this change is much welcome. And the other is the introduction of a timeline during which an excise license should be issued. I would have a contention with the number of days, making it about the 14 days just a bit, but the thing is that in a lot of government offices, you declare everything, and then of course, there are those delays that make you wonder whether you have a right as a Kenyan, as a taxpayer. And so when we have an introduction of timelines in many departments, then something like this would happen, whereby you reduce, you are certain that when you apply for this permit, when you apply for this license, provided you have given all the information, you'll get a response saying yes or no within a specified timelines. This is a very good change. On the issue of tax rates, before the tax rates, first, for those of you who are not aware, the Finance Act 2023 introduced a new timeline for payment for remission of taxes by manufacturers of alcoholic beverages. So they were not let to pay the taxes on or by 20th of the succeeding month, but they had to remit taxes, excise taxes, for any deliveries or any goods that left the excise stockroom within 24 hours from that delivery. And you can imagine the issues with having to have those frequent transfers and the timeliness and the rushing, etc. And obviously having to make such payments for a business so often might not be the best thing, especially because it's not guaranteed that you receive payment immediately as well. And the reason why that had been done, first of all, was because of a lot of non-compliance within the industry, which was in terms of evasion and, of course, people not remitting the correct amounts of this when it comes to payment. And so, as one of the compliance and enforcement tools, this was put in place through legislation. And I think through the industry going back and forth with the ministry, etc., this has been rectified and it has been extended to 5 days. I hope this works for them. Yeah. And now on the tax changes, there's been increased rates for various goods and changes on which goods payments are done or not. I think at the beginning I mentioned about motorcycles, where excise duty has been dropped on all motorcycles apart from motorcycles of a specific tariff. And that tariff talks about electronic motorcycles or motorcycles with an electronic motor, apart from if it's in an ambulance or it's locally assembled. And it increases the tax rate, not just itself being left tax, but it increases the tax rate by 1,300 shillings or thereabouts, or a total excise duty of 10%. So before it was 11,608, and now for only electronic motorcycles, we have 12,952. For me, it shows that we are making electric motorcycles more expensive and therefore discouraging their use. Yeah, so when we see our dirty border borders on the street and we're like, we wish they could adapt use of electric motorcycles, then of course attacks like this will not be encouraging for them to move to electric motored motorcycles. The other thing, and I think this is a win for public health and the tobacco control advocacy, is that the excise rates for cigarettes with filters and the cigarettes without filters have been matched. So we have a uniform excise rate. For clarity, for most of us, Kenya is a signatory to the Framework Convention on Tobacco Control, and one of the requirements for the parties is you should have a uniform tax rate. Of course, we are not going to encourage anyone to shift from filter to non-filter using lower tax rates. That's not something that you'd wish to see happen. In fact, the goal is to have less and less people resorting to smoking. And so this is a welcome move, the uniform rate and the increase to 4,100. Of course, I would love to see a date where we have higher excise duty to retail price, the percentage to be higher. I think the recommended is 70%. Currently, we are at about 26. Let's see whether we'll have an overshifting or undershifting or a consumption of the taxes that have been added, and see how that will affect the excise duty to retail price rate. Then there's some increase in the products containing nicotine and, of course, liquid nicotine for electronic cigarettes. And I think I would be preaching to the choir if I started explaining to you the issues that we are facing as a country and out of the consumption of nicotine products by our youth. And so the increase in tax is welcome. And hopefully in the future, we'll see this increase as from a public health perspective. And my hope is that in future, we see more and more of Ministry of Health getting involved in tax policy concerning products that are of a health concern. The other issue is that there is a change in how alcoholic products are taxed. In the current regime, we have a specific rate for beer and the spirituous beverages of an alcoholic strength of less than 6%, what people refer mostly as ready-to-drink beverages. And we have a rate for spirits of undenatured ethyl alcohol, anything that is above 6%, the whiskeys, the vodka, the pure ethanol. So there's a current rate, which is just per liter. And then wines have their own rate per liter. So what the Finance Bill 2024 proposes is a shift from this excise duty rate per liter to a specific rate per alcohol content that is one beverage specific. So there's one that is beer, there's one that is spirit and wines, and then the concentration brackets or the concentration. And therefore, beverages with a higher alcohol concentration attract higher taxes. So if you are making a product that is 40% and another product that is 32%, obviously you pay different taxes. Now, I do not know what formulas the Treasury used to come up with the excise duty rates that they have come up with. I think any way of dealing with tax policy on beverages is quite difficult, whether you're dealing with a specific rate or ad valorem, which I certainly hope not to see around. And the evolution currently is basically to charge according to the alcoholic content of the product. But anyway, depending on enforcement capacity and many others, external factors, then tax policy would always have some level of complexity. And so with the new change, then we have beer taxes going a little lower, and for spirituous beverages, spirits going a little higher. There's an increase in for spirits and a reduction for beer. I'm not sure what advises the reduction of taxes of beer, because alcohol is alcohol. There is no alcohol with less effect. Of course, alcohol that takes a longer period in the system to be ingested, etc., like the beer, and that might be seen to have a lower rate of having issues with the health of the person, then less taxes than the higher taxes. But my view is alcohol, and I would be very concerned if we worked towards reducing the taxation on the product. There's one that Mokaya mentioned that I know for many people is a pain when you have the proposal for introduction of excise duty on vegetable oils. Now, I will still speak as a health taxes person, where there isn't much that I would need to add on the effects of trans fat on the human being. So when we talk about vegetable oils, of course, I would want to see a situation whereby that the healthier products are taxed less than the trans fat. That you would want to see things like olive oil that is safer for the use by the person, attracting less tax than the yellow jerry can of cooking oil that we buy, because of course we know the dangers that it has. And one of the reasons I was talking about the Ministry of Health being involved in such matters is because I believe they should also be on the front line, educating the masses on the dangers of using water and all that, in order to see people transform how they live their lives, change behavior, as the taxes might not be enough. The thing, though, is I do not think that Treasury introduced this tax for health purposes, but rather as an avenue to collect more revenue.
So no, I agree with you on that last statement.
Even the structuring and everything, I highly doubt that was an item for
All right. Now, one of the things I wanted maybe to have a look into is some changes in the Income Tax Procedures Act. Could you explain to us a little bit what that means in terms of the exclusion of weekends and public holidays from the computation of the tax period?
All right. Thank you, Mokaya. I will go through some of the proposals that are in the Tax Procedures Act. And the first one is the exclusion of weekend public holidays from the computation of tax period. And probably to give an example, is we file our VAT return on or before the 20th day of the month. So we count the days based on the calendar days and not the working days. So what this proposal aims to do is to exclude Sundays, Saturdays, and public holidays from the period, meaning that if a VAT return is due by 20th and 20th falls on a holiday, then you can submit it on the next working day. What needs to be done? This is a good proposal. However, the iTax system needs to be configured in such a way that it allows for such, because currently when you file a return on 20th or 21st, despite 20th being a Sunday, it will attract a penalty. And this provision is not just for tax return, it's anything related to taxes. For instance, a notice, if you need to file an objection, any other document that relates tax matter, then if the due date falls on a holiday or on a Saturday or on a Sunday, then you consider the next working day. The other proposal on objection, currently the law allows a taxpayer who is aggrieved by a decision that has been issued by the commissioner to file an objection within 30 days. Thereafter, the commissioner has an obligation to respond to that objection within a period of 60 days. So what the proposal is aimed at doing is extending the period within which the commissioner can respond to your objection. Currently it's 60 days, but there's a proposal to extend that to 90 days. But now the question of fairness comes in, because if us as taxpayers, we are given 30 days to file a notice of objection and KRA has 60 days to respond to the notice, they have now been extended to 90 days, then why also not give taxpayers an extension to be able to also put in the necessary paperwork to file their notices of objection? Then there is a proposal again on objection decision. The finance bill is proposing to introduce a provision which says that if you file a notice of objection, if you are aggrieved and you file a notice, and you are not able to provide documents that are requested in the course of the objection, then your objection is deemed disallowed. So the question is, at what point, because if you file your objection today, then a request comes in for documents and you are taking some time maybe to retrieve some of these documents, at what point will the objection be deemed to be disallowed? So there is no clarity on that. But the proposal is that if you do not provide the information that has been requested, then your objection will be deemed to be disallowed. The other proposal is a proposal to reintroduce what we call abandonment of taxes. So previously there was this proposal, but it was scrapped by the Finance Act of 2023. So what is the finance bill is seeking to do is to reintroduce the provision to allow, to give the commissioner powers to not recover certain debts. And what are the circumstances? So if the commissioner has written to the cabinet secretary saying that it is very impossible to recover this debt, or the expenses that the commissioner going to incur to collect the debt is more than the tax that is trying to be recovered, or if there is any hardship, for instance, if somebody has been declared bankrupt or a company has become insolvent, so the commissioner will have powers to abandon the tax. So it's a good proposal because there are those instances where taxpayers get into a situation where they cannot pay the taxes. The question is, what measures are there to ensure that this provision is not misused by people saying that they cannot pay, but ideally they can pay? Then there is a provision in the law which provides for exemption from withholding VAT for investors who have invested at least 3 billion shillings. There is a proposal to eliminate that VAT, withholding VAT exemption. It's to say that they will not, when you are supplying or when you're dealing with such person, then they will not qualify to be exempt from withholding VAT obligation. So the expectation is that you would deduct withholding tax on their supply. The one is for export processing zone or export processing zone enterprises. There is a proposal to reduce the penalty, because currently the penalty is 2,000 per day for failure to file or to submit the documents that they are required to submit. But the proposal is to change this to 20,000 per month instead of a penalty of 2,000 per day. There is also an interesting one where the finance bill is proposing to give powers to care to do migration to your accounting or your reporting system. So if you have a certain accounting system or an ERP, the finance bill proposes to give powers to the commissioner to integrate so data or your sales and your stock data is submitted to KRA on a real-time basis. And the offense is you do not submit data is 2 million per month. So this is a very punitive proposal. And the question is, we have been talking about that confidentiality and all. So if you have to integrate into a taxpayer's, then I don't know whether it will increase dispute. But I expect and I foresee a situation to increase dispute in terms of how much information does KRA need to see or what do they need to do. So that's it about the tax procedures act. I can't remember any year, but that's about it on the tax procedures.
I think we covered the major highlight in terms of the final bill so far. Karambu, did I miss out on some things to do with excise duty that you wanted to highlight a bit more before we open up the floor for questions?
On excise duty, I think what I needed to add is that apart from the vegetable oil, we also have the inclusion of, I think, coal to be excisable. And then there is the introduction, I'm sure last year we had the Finance Act 2023 introduced the excise duty on advertisements on TV, newspaper, and billboards. And so this year, what has happened is the same has been extended to internet and social media platforms. Of course, this ensures that there's consistency in taxation across the various platforms. And because gambling and all that is, of course, we have, I'll not call it a small issue. To one of the things to reduce gaming, of course, was to increase excise duty, and betting was to increase excise duty, and the introduction of excise duty on the advertisements becomes one of the measures.
There was a quick one you were talking about gas in this African region.
No, not gas is an addition on excise duty. Currently, imported egg, onions, and potatoes attract excise duty, but there is a proposal to exclude the East Africa countries from that provision. And my concern is local farmers keep on complaining about the prices for products that are coming from Uganda, Tanzania. So now, given that there's a proposal to remove excise duty on those products, then question is, will the local farmers be able to compete with East African produce, and what does it mean?
So in terms of the East African community, there's been contention as to whether or not we can charge duties on products that are produced within the territory of the East African community. And to my understanding, there has been a case where the government lost on imposing excise duties on products that are manufactured or produced within the East African region. So this has been something that has been long outstanding in terms of implementation. Just to be clear, as per the East African Community Protocol, that all products that are manufactured or produced within the East African region are not subjected to duties because duty-free environments for moving of goods.
I think one of the concerns I would have with how we deal with excise duty to protect our domestic sector. They're not supposed to be used as a tool to protect the local manufacturers or farmers. So when we do that, then we mess up with what the agreements say, ESC, COMESA, etc. So if really the government is looking at protecting local manufacturers and agriculture, the tool to use is import taxes. Nobody will take you to court for import taxes. If we keep using excise duties, first there was the manufacture of glass bottles, and then there was the manufacture of plastic bottles, and then there was the onions, and there is the egg. All that, you are missing a point. I think what Treasury should do is consider agreeing with the other regions, even with ESC, because there are certain things, especially like from COMESA, import duty would still apply, but using domestic tax, for me, I struggle to see how that should help, because we're the same people who complain about importing goods to Tanzania and then being charged an excise duty higher for sodas, etc. when they go to Tanzania and vice versa, but we still use the same gimmicks. So I think we need to really check out how we play with
All right. Honestly, do you have something to add before I open the floor to questions?
Oh, yes, under the Income Tax Act, there are some amendments that touch on employment income that are generally good. The first is tax-free amount for benefits in kind has been expanded from 36,000 shillings per year to 48,000 shillings a year. The tax-free limit for food or meals provided by an employer at the workplace has been expanded from 48,000 shillings to 60,000 shillings, in effect 4,000 shillings to 5,000 shillings a month. And the benefits for mortgage relief have been expanded from 300,000 to 360,000 shillings per year. So in effect from 25,000 to 30,000 as the interest relief. So I think that is good. In terms of per diems, you'll recall in the 2023 Finance Act, the per diems were exempted from income tax. So the 2,000 shilling limit had not been deleted, but in effect made redundant. So that now has been removed. So the 2,000 shilling limit has been removed. But now employers are required to have a traveling policy on how to make payments and account for subsistence allowances or per diems. These per diems should not exceed 5% of the salary of the employee. I don't know if this is the monthly per diem or the daily per diem. From my reading, it looks like the 5% capping is the daily rate. So 5%, if your salary is 100,000, your per diem shall not exceed 5% of that amount, which is 5,000 shilling.
Well, government employees rely a lot on per diems. Does that affect them also?
Yeah, potentially it should, because the Constitution doesn't allow a discrimination. There will be fairness. So potentially it would apply. So probably SRC will have to review their rates. However, but this 5% capping will not be appropriate for international travel. It may create difficulties in implementation if you have to go to a country where the cost of living is very high, especially European countries. And this rate that I've applied here on the daily rate rules impose significant restriction. So I don't know how this needs to be revised. And if I was asked, I would benchmark this on the SRC rate so that it is more or less fair.
All right.
So that's what I wanted to add.
Okay, a lot to unpack. I think in the last hour and a half, lots of content. So I think if you're overwhelmed, it's okay. We will produce this as a podcast and then you can listen to it very slowly. And of course, provide you the PDF and then you can go through some of the questions and then we'll have another session on this sometime soon again to clarify some of the things that we may not clarify today. So that's one thing to note. Now experts are always available. If you write your question and you tag us, we'll definitely be able to forward them to the appropriate experts in the team. I should say also that I think one thing that I've noted, and I think Amboko suggested this, if you want to make your responses to Parliament on some of these provisions, just select a few provisions, 1 to 3, something that affects you that you can analyze very quickly. Create a 3-column document. Just column 1, just write the specific provision that you want to comment about, and column 2, make a specific suggestion, and then column 3, you can put a bit of justification on this. And if you need some help from an expert, tax expert, maybe to draft that, it will be very important. It's very important to participate in this process. I know sometimes it feels very like some of our suggestions don't go through, but actually Parliament does go through a lot of these provisions that get forwarded. But sometimes it may not impact this year's. It can also be featured in maybe the following years in terms of them listening to you and your suggestions. So don't despair. Please make sure to swarm Parliament with as many of your suggestions as possible. And I can see a lot of things on the motor vehicle tax. Just make sure that don't just tweet about it, but you also actually take time to draft a proposal and send it to Parliament, and so it can be heard at the end of the day. So a couple of questions before we wind up. So I want to start with 2, which we did not maybe touch about. One is KRA being exempted from the Data Protection Act. And number 2, there's a proposal which suggests that the infrastructure bond, especially those, I think with less than a period of 3 years, will be no longer be tax exempt. So any of you who wants to comment on those 2, as I also look around for a few more questions.
So with data protection, since you operate a self-assessment regime, there is information asymmetry where you know your transactions better than the revenue authority. For the revenue authority to be able to do an assessment, especially in situations where there is fraud or growth in non-reporting of income, then KRA would want to use other methods to get information about you. So it would want to see your M-Pesa details, it would want to see your bank details. So if a restriction of this nature is imposed and someone has gone to great length to hide income, then make it very difficult for them then to discharge their responsibilities from the income tax level. So the need to exempt them from that data protection requirement is necessary for them to discharge their responsibility. Also, on the other hand, a lot of restrictions are imposed on revenue officers in terms of confidentiality. If from a Tax Procedures Act point of view, from the Data Protection Act point of view, any data breaches or use of that data for purposes other than tax assessment, yes, will have severe penalties on the officer involved. So it's expected that they will hold that data with the highest level of privilege and confidence. What was the next other question?
The other one of them, the interest income being subjected to tax. I think withholding tax at 5%. I think that's the suggestion.
Oh, yes. I think so that one was purely a revenue enhancing measure. I think once they've seen the interest that was created and given the high interest rates also, the interest rates have significantly increased in the last 1 year. I think the government wants to recoup a portion of that interest that they are paying out. When these were being mooted, the rates were lower, but now at this high rate, it will make sense that they want to recoup a chunk of that money.
All right. I think that's been sufficiently dealt with. A question on taxing smallholder farmers and their engagement in building the economy. Is there any suggestion around smallholder farmers being taxed in this finance bill 2024? And then also there's a question here on maybe a bit of expounding on the eco taxes that are coming up and clean energy and some taxes to help out on clean energy. So eco taxes, there's quite an extensive proposition there. Any breakdown, a quick one?
Health tax expert.
Yeah, so someone had asked whether the increase in these taxes contribute to an increase in NCTs in our setup. And apart from just collecting more revenue, what else we should foresee as the cost of caring for NCD patients is too high. One of the jobs or what the Treasury is supposed to do when giving a budget, it's not just about collection of revenue. Let's just have revenue. We are supposed to collect revenue for development, for the expenses that the government incurs. Of course, we want to see that they're spending the money well. And one of their responsibilities to you is your health. Yeah. Behind health taxes is not just a tax to reduce your consumption of a product, but these taxes are supposed also to be used for the benefit of the health of the mwananchi. So if taxes are increased on alcohol and taxes are increased on tobacco or trans fats or sugar and sweetened beverages, then we need to see the government also using these finances to cater for the management of your health. So in our health facilities, then they should be able to cater for persons who are living with NCDs. And so they're supposed to plow back these funds to dealing with NCDs. So many governments I know do not want to do what we call earmarking of funds. Earmarking is when you take, like the way we were talking about fuel levy earlier, when you'd say that the money for fuel levy goes direct to the maintenance of road. That is earmarking, where those funds cannot be used for anything else. So many governments will avoid doing that and say that they will budget for the health need of the country and if they are of the nation, and if there is any other requirement of cash, they can always reallocate. And many consider earmarking as a space where I think many ministers of finance, let me put it that way, will consider earmarking means that they cannot push other funds toward health because there's a specific fund for cancer. If all the tobacco taxes are going there, etc. But that's not entirely true. You can earmark funds and ensure that these funds that are being collected from these specific products are going directly for the taking care of the mwananchi for this and that. Maybe you can say that the excise duty from motorcycles are taking care of people who are the way our public hospitals have wards that are full of guys who've had motorcycle accidents. That example of earmarking, if they took certain funds there Of course, it should be easier to ensure that we have road safety training and we have compliance, but that is the essence of using of earmarking fund for health purposes. So when you increase taxes, I know there are people who look at it and say, so you've increased taxes for spirits from 300 and something to 572. So then what this means is that we should expect an increase in illicit trade. But no, illicit trade is a crime. Taxes should not be the ones that lead to criminal behavior. And then also, apart from working on the tax policy, then the government should invest properly in administrative tools that actually work to ensure that we've not just increased these taxes to reduce consumption of the product, but we are also eliminating illicit trade in these products so that the tax policy actually works. So tax policy of a country is only as strong as its administration. With that, then I do not see how the high taxes would lead to the increase of the NCTs. So it's an issue of balancing the policy, the expenditure of the administration of these taxes, and then how these taxes are used by the government to take care of its people.
Thank you for that. We are nearing the 2-hour mark, so I think we should start winding up. So I think a couple of questions, but definitely we'll organize another spaces on this. I'll give each of you maybe a couple of minutes to give us your closing thought. We can start with Ruth and then Karambu and then Ernest at the end. Ruth, maybe you can give us a few closing thoughts and perhaps some key takeaways that the Mwananchi should think about as they go through the provisions and make submissions to Parliament in this regard.
All right. I think first is to note that the government is really being very aggressive in terms of collecting tax, and my recommendation to all Kenyans, one, is to at least make sure that you have a basic understanding of the laws that relates to tax, despite what we are discussing today being proposals that some of them have a negative impact on that. But whatever already is in law, at least try and comply to avoid being in a situation where you do not have money and the government is on your case. But just to comment on the Finance Bill 2020, to say that my hope is that the government will consider the public views so that any taxes that are not necessary, that the VAT, the proposed introduction of VAT on financial services, the motor vehicle tax, can be reviewed to a later time, at least to allow Kenyans to at least just what had been implemented in the past, because it's too much happening and sometimes it's very difficult to keep track. I really hope the government will consider those proposals and listen to Kenyans so that Kenyans are not suffering when you are promising Kenyans that they should be enjoying. So thank you very much, and I really look forward to the amendment, and hopefully they will be positive.
Then I want to ask the listener really as much as possible to participate in the public participation. I've seen it work in certain years. I cannot speak for last year, but I've seen it work in many other times, and even on other different laws. I have seen that public participation is a process that can actually work. I keep saying that the worst that would happen when you ask for something, the worst that can happen is to be told no. So kindly participate in this activity. And even as Ruth has said about trying to have some basic knowledge on tax, I think that's something that we should also inculcate in our children so that they do not get the shockers that we have gotten as adults, for not understanding what goes on and then having to deal with taxes when we're adults.
Thank you. Ernest, any closing thoughts?
So at least now I know I need to get an air fryer, stop using vegetable oil. In terms of public participation, just to add, one of the feedback I have gathered along the way is that members of public may not write their representations in a way that is very specific for it to be inserted into the taxation laws. In terms of writing your feedback, the most encouraged way is to write the specific wording that should be inserted in each specific section of the law, so that then it makes it easier for those who are going through the issues raised to be able to incorporate it into the law. When people write in composition form, sometimes it becomes very difficult for them to craft an amendment to the specific tax law. And so you find public participation becomes negated by the type of drafting that has been adopted. And given the short timeline that the Parliament has to review all that information, then it can easily be omitted. So that is my experience I have seen over the years of public participation. In terms of small-scale farmers, this bill does not touch on them, but the tax laws as they are designed will cover them. For example, any person whose income from business, including agriculture, is less than 1 million, that person is expressly exempt from any form of taxation. So if you're a farmer and your total income in that 1 year and all other incomes that you have is less than 1 million, no taxation. So even if you get incorporated into eating and at the end of the year, your total farming income was less than 1 million, you get exempt. The tax rate in terms of turnover tax for most business people whose turnover is less than 15 million is 1.5%, as was reduced by the Affordable Housing Act from 3%. So any farmer who is then captured under the income bracket of 1 million to 25 million will pay 1.5% of the gross revenue taxation. So as a farmer, then probably you need to enlighten yourself on the tax requirements once you've been incorporated into e-teams to ensure that then you pay the appropriate tax rates. So it is hard to design a tax that excludes farmers because taxation systems have to be fair. And if you're a large farmer or fairly large farmer, then you'd be caught up if you're earning a lot of money. But for the tiny, small-scale farmer, you'll be excluded by the existing tax law. And in terms of the computation of time, trying to get my head around how this provision will work. Does it amend the existing provisions? Does it supersede the existing provisions? And in terms of computation of period and excluding Saturdays and weekends and public holidays. So I don't know if it's an indirect amendment of all the provisions. Still, the VAT Act, let's say, returns should be submitted by the 20th. Does that mean VAT Act now is amended to say returns should be submitted by the 20th working day of the month? So I'm trying to understand how this will work going to the future. Thank you very much for this opportunity.
Thank you. I should say Ernest has been on Citizen this past week trying to explain the finance bill in Swahili. So if you can catch some of the links on, you can find a bit of a breakdown in Swahili. Thank you so much, Karambo, Ruth, Ernest, for helping us unpack the finance bill. I think we should have you again soon. Maybe next time we'll focus more on the questions that people are asking. Please listen very carefully to what Ernest has suggested. If you're trying to make a submission to Parliament, make it as simple as possible. Say, retain this instead of deleting it, and then make sure that you have a good and really small justification. If you search online the commented version of the Finance Bill 2023, you can see a few of the comments as Parliament received. So make it short, make it simple to understand, and make it really punchy. Remember, they don't have a lot of time. It's 13 days to comment, and then maybe after that, it needs to go to the second reading and stuff like that. So we have very little time for that. But make sure to participate in the process timely. It's your duty as a citizen to be part of these processes so that even if you're not hard, at least you can say that I wasn't hard, or at least you made a particular submission. So if you have any questions, our DMs are always open. Below the pinned tweet, you can always ask our questions. I can see a couple of questions that are more general. I think we'll tackle them. Time goes by, we'll try and send them. Maybe I can give you a second or two, each of you, to say where the people can find you, because I know you're a tax expert and you are in the profession. So you're also looking for people to help out in this regard. So maybe Ernest, Ruth, and Karambu, you can quickly tell us where people can find you. Ernest, tell us where people can find you.
My email is info@ernestandmartin.com. So any queries on that email will be responded to.
Karambu?
You can email me on karambu.mudhaura@gmail.com and I'll respond to your questions.
Thank you. Ruth?
All right. Probably on Twitter, Ruth Mwiti, 2, or my email is info@taxservices.co.ke.
Thank you so much for joining us, the three of you. People in the audiences, very nice to have you here also. Thank you all for making time to be with us. Don't take it for granted that you took your time, around 2 hours this evening, to listen to us break down all this Finance Bill 2024. It's very good to see interest in some of this technical stuff. They're important and they're very good to make a commentary on.